record, phone call, all kinds of things going off here now. Okay, well, I'm going to drop back to the home page here. I sent a message earlier. It's been a little bit hard for me to keep up with you guys. I've got some things going on with family members' health, and so I've just fallen a tiny bit behind. But I have added up here today, as a matter of fact, another article about hobby businesses, which is something we'll probably talk about tonight when we talk about the Schedule C, and then a useful item that is just sort of a summary of all of the different business entities. And so this really talks about limited liability companies, S corporations, regular corporations, Schedule Cs, and just a little bit of the differences between those different items. And sometimes I find it kind of nice to have a summary like that because it's all contained on a single page in this case. And so some of those entities are what we refer to as flow-through entities or pass-through entities, and other entities are separate. And so a corporation is a separate entity that files a separate tax return. In the corporate sense, it's an 1120. It's a Form 1120 is what it is. But a sole proprietorship, in contrast, is a pass-through entity. And so what we do is we include that income on the owner's tax return. And we do that by way of the Schedule C, which is going to be a reporting of the business income and expenses. And then eventually the profit from the business is going to flow through to the front of the 1040. So when we talk about pass-through or flow-through entities, that's what we're meaning, that the income is ultimately being taxed on some individual's tax return. So the other thing here that I mentioned in my note, the second midterm, we're not going to do it this week. I've got a tiny bit of work to do on it still, and I want to get your Anderson tax returns graded first, and so I'm just going to delay that, push it into week 7. It'll still be Saturday of week 7, so that's going to give us a little bit more time to prep and a little bit more time to catch up. So that's kind of the housekeeping things that we need to do tonight. And so on to our Schedule C. You know, much like our Schedule A or our Schedule B, you know, some of the things we've looked at, the Schedule C is just a form that gets attached to the 1040. And I want to take us through the masthead up here. These first A through J talk about some of the important issues that are also covered in the chapter in that area. We'll talk about the income and then the expense categorizing. And then we'll talk down here a little bit about the home office deduction, but I'm going to do a separate video that covers the form for the home office deduction because it's worthy of 15 minutes on its own. And then we'll calculate the profit, and then we'll talk a little bit about these little check the boxes thing down here on 32A and B. So there is additional parts or a page 2 to the Schedule C. This is just a cost of goods sold calculation. I'll probably say a couple of things about that. And then this is the vehicle information, and I suppose I'll have to say a little something about that. And then these other expenses are just expenses that are included in the first part that don't fit nicely into one of the categories. So let's scroll back up here to the masthead and kind of, you know, that's just kind of a really brief overview. Let's kind of take them in order. So starting with, you know, the name of the business, generally, here's how this works. If you use your own name in some way in the business, you probably don't have to do anything. So if I say, you know, I'm operating as Chris Culver's Lemonade Stand, then I'm in business. I mean, just that's it. All I have to do is just, you know, start using the name. If I use a name that's other than my own, let's say I want to be Lucky Lucy's Lemonade or something. In that case, then, since I'm not using my name, I have to do what's called a DBA, or an assumed business name, and this is not really a tax issue, but you go to the Secretary of State and you get a one-page form and you fill out some information and you basically tell the public, Lucy's Lucky Lemonade is owned and operated by Chris Culver, and if you need to, if you have a complaint or need to file a suit or something like that, here's all the pertinent information on how you contact the owner. So in each state, the Secretary of State does that, but you only need to do that if you use a business name other than your own. So that's a little bit about the name of the proprietor here. Then you indicate what your principal business is. So it could be, lemonade sales. It could be, a bookkeeper. It could be a real estate agent. It could be, just whatever type of business it might be. And it can run anything from, smaller individual people that are providing services on up to businesses that employ multiple people and have complex operating situations. And so in E, we're just going to do the address and phone number. I want to come out over here. The Social Security number is going to be the same as the taxpayer. So like for the Andersons, if they happen to have owned a business, then you would just use their Social Security number. And then you enter a business code, this line right here. And I want to spend a moment with this one. There is a list in the instructions for the Schedule C that kind of, there's probably 100 codes for different types of businesses. And so if you're a real estate broker and sell real estate, there's a specific code for that. If you're a manufacturer of healthcare supplies, there's a specific code for that. Choosing the right code is pretty important because what's going to happen is the IRS is going to take every tax return that's filed with that code, and they're going to build some statistical averages. And those statistical averages then is what your tax return is going to be compared to. And so your Schedule C will be compared to all of the other businesses that have that same code, and they'll look at the averages. And if you have an average that's really way out of whack in comparison to, the other similar type entities, then that might be a cause for concern. It doesn't mean that you're going to get audited, but the more abnormal you are from, the averages, kind of the more points you're collecting in terms of maybe being something that you might want to be, that the IRS might want to look at. And so there's nothing special about that code. It's just I wanted you to understand, that choosing that code and trying to maybe ask a client, now, what kind of business are you in? What do you do? And really understanding their business so that you can select the right code could be an important thing. If they have an employer ID number or an EIN, we would put it in here in D. Most businesses get a separate tax ID number because if you have employees or if you're sending out 1099s to contractors or just, all kinds of things, opening bank accounts, all kinds of things that a business might need to do, you may not want to use your personal Social Security number because that makes you more prone to identity theft. And so whenever your business starts to get a little bit more complicated, you may have to put your Social Security number up here on the Schedule C, but most of your other forms that you would use, you might prefer to have an employee or an employer identification number. You always have to have one of those if you start doing payroll, but there can be other situations where you may want that number as well. So then the accounting method, line F. Cash is kind of a common one for very small businesses. And with cash accounting, you have revenue when the cash comes in and you have expenses when the cash goes out. Technically, in a cash basis business, you don't have any accounts receivable and accounts payable. But from a practical standpoint, what happens for a lot of small businesses is they will do accrual books. So they'll have receivables and payables, but then they'll adjust those books to cash in order to do the taxes. And so let me explain how that might work. You might have sales of $100,000 on your P&L, your profit and loss statement or your income statement. But you might have $10,000 in accounts receivable. That $10,000 in accounts receivable is revenue that you haven't received yet. So under a cash basis method, we would only report $90,000 worth of revenue. So for your sales in a cash basis, you would do sales minus accounts receivable because that hasn't turned into cash yet. And we do kind of the same adjustment with accounts payable. If our expenses are $50,000, but 5,000 of them are in accounts payable, well, we technically can't count those accounts payable as expenses yet, so we have to take them out because we haven't parted with them yet. We haven't consumed or had the cash leave us. Taxpayers, particularly in small businesses, they prefer the cash method. And the reason being that I can look at my P&L at the end of the year and say, it looks like I have about $2,500 worth of profit. And if I need to incur some expenses for next year, like if I need to buy some more supplies or I need to purchase some inventory or there's things, I may be able to incur cash expenses that will drive down my net income, which will drive down my tax. And so you can kind of, I don't like to use the word manipulate, but with the cash basis, you have some flexibility to try to control your profit for tax purposes. Accrual accounting is the accounting that probably, I'm thinking that almost all of you guys have taken some accounting classes. So if you had an intro to the accounting cycle or a financial accounting class where they did where they had accounts receivable and accounts payable, and maybe you had prepaid insurance and you had adjusting entries, that's accrual accounting. So you just have to check the box here, whichever one that you are. As a business becomes very large, there are some rules in the tax code that says you must become accrual, but for most small businesses, it's a choice. And you choose by just checking the box the first year. And then after that, you're not supposed to change. So if you check cash and you're a cash basis company for 4 or 5 years, and then you decide, well, we'd like to be accrual now, you actually have to go through a couple of extra steps to make that change with the IRS. So line G, did you materially participate? And this is kind of an important question. And all of this is kind of gone over in the chapter, but material participation is important because if you materially participated, then you can do, well, 2 things happen. You can deduct your losses because they were at risk. So if I have income from other sources and I have a $2,000 business loss, I can take that loss against other activities if I materially participated. And then the other thing that may come into play is if I materially participated, I owe the self-employment tax, which is the Social Security and Medicare tax. If I didn't materially participate, then I'm just an investor and I don't necessarily get to deduct my losses, and I probably don't owe the self-employment tax. The definition of material participation is if you help operate the business, and lots of times we'll talk about this 500-hour rule. You contributed, up to 500 hours or the majority of your time. But there's a little exception that causes most people to meet the material participation rule, which says if you're the only person who is active in the business. So if you're the only person who's active in the business, then by default, you materially participated. So some people will have a business, I don't know, there's a lot of these network marketing activities, trying to think of which ones come to mind. Party Light, I'm drawing a blank here, but there's a whole variety of those types of endeavors, and very few of those people spend their entire career doing that stuff or all of their working hours doing that. They do that in addition to their regular work, and so they maybe don't meet the 500-hour test, but they're the only person in their small business that's actively participating. So by default, they sort of meet the material participation test. So on G, you sort of assess the situation and check yes or no. In H, that's just if it's a new business, so the IRS can know that like, oh, this is the first time that we're seeing this form. I and J are, these are trick questions. These are designed to try to catch you. And I is, did you make any payments that would require you to file 1099s? And so we need to do 1099s to vendors that we paid money to that are not incorporated in excess of the $600 mark. So if you pay your accountant $1,000 and they're not incorporated, then we're supposed to send them a 1099 at the end of the year. And so I is, should you have done any of those? And then J is, did you do them? And here's the little trick, right? If you didn't do them, it's a $500 penalty if the IRS catches up with you. But the problem is if you were supposed to do them, but you say in line I that, no, we weren't supposed to do them, now you've actually lied with the intent to deceive the IRS, and so you've committed tax fraud. And so you want to, go through your accounts payable, look at your vendors, see who you paid more than $600, and then if need be, appropriately complete the Form 1099s and send those to the IRS and to the vendors. That's part of how the IRS tracks income and makes sure that most small business owners are reporting the income, because they're expecting, that if a plumber gets a 1099 for $1,000, they're looking for that $1,000 of income on that plumber's tax return. So the rest of the return, that was actually kind of some of the big stuff that we needed to talk about. The rest of the return is like more fun than all of the tax stuff we've done up to this point, because it looks like accounting. It actually looks like an income statement. It looks like a P&L. It's normal instead of being like taxes. And so line 1 is just, total revenue, gross receipts, top line, whatever your total income is. And you may have multiple categories. Let's say you're a photographer and you have, commercial sales and then portraits that you take and then senior photos. It would be the sum of all of those things. So you might break it down in more detail on your income statement or your P&L from, maybe from QuickBooks, for example, or however you keep your books. You might have more detail for your books, for your purposes, for decision making, but we're just going to put all of that income on line 1. Then if you have returns and allowances, we're going to list those separately. So those would be refunds to customers for you took products back or basically had revenue that came in, but then you refunded it to the customer. So line 2 would be a subtraction. Line 3 is actually where we do the subtraction and drop the number. And then line 4 is cost of goods sold, gets us to gross profit. And then other income is kind of like line 21 on the 1040. It's kind of like where we put business related things that we don't know where else to put. So if your business had a separate, investment account and you had a little bit of interest income and it was reported to the business's tax ID number, you might be dropping something like that on line 6. So since in this income portion up here, they list cost of goods sold, line 4, I'm going to scroll down to cost of goods sold, which is kind of here on page 2. And it's very much like how we've calculated cost of goods sold for accounting, where we generally take beginning inventory plus purchases equals available for sale minus ending inventory, get you cost of goods sold. And you probably, I think most of you have had accounting, and so you probably recognize that formula. And we're in essence using that formula here with just a few modifications. So the first line here, 33, is how are we calculating the inventory value. Usually it's always at cost. If you're a GAAP accrual accounting person, you may be doing lower of cost or market, but it's usually A or B. Others, C is kind of a weird situation. It's almost always A. And then line 34, were there significant changes? If yes, we want to, make an explanation, but most of the time it's just like, no, it was just business as usual. And so line 35 here, inventory at the beginning of the year, that's going to come from the ending inventory last year or the tax return or the books from last year. Purchases, less items that you may have taken out of the business. So if you're extracting inventory from the business for personal use, you're supposed to, sort of deduct that out. The only place that I can think of where this really comes into play a lot is sometimes in small restaurants where the owner is eating a lot of their inventory. And if they're eating a lot of their inventory, they probably should be taking it out on line 36. reducing, their total purchases number. For many small businesses, if they're eating a small amount, I'm sure it's just getting, rolled into spoilage or lost. So inventory at the beginning, purchases. This is labor cost. If you were manufacturing, and so you were creating the products, you might have inventory for raw materials up here, and then more purchases for raw materials, and you might have labor to convert those raw materials. Say you're buying axles and steel and you're welding them together to create trailers. Well, that cost of production, that labor cost for production, if it's not you, the owner, then it's going to go on line 37 to be added into the inventory. Materials and supplies. So these are materials and supplies that ultimately are used in the production process for the creation of the inventory. And then, sort of, again, a line for others, add them all together, right? So this is really beginning inventory, and then 36 through 40 is like plus purchases, but expanded to include other things. And then inventory at the end of the year, which becomes a subtraction, and line 42 becomes cost of goods sold. And so line 42 is where we get this line 4 that we mentioned up here. And again, I don't think that calculation stumps you at all or causes you any trouble. It's just you go to the second page of the form and you sort of apply your understanding of accounting to crunch that number out. Then just a couple of things about expenses here. I'll scroll them up so we can kind of have them in the top, lines 8 through 27. One thing that will sometimes drive, I guess the two issues that kind of drive tax preparers crazy, or maybe people that are new to the Schedule C. One, I think, is, is it an expense that we can deduct? And then the other one is like, well, which category do I put it in? Let's start with the second question. Which category do I put it in? You put it in the category that best fits. If it doesn't fit well, you can put it on line 27A in other expenses, and then you can describe it. So this line 27A are expenses that don't fit into these other categories, and then they're listed right here. So you may, I don't know, whatever it might be, you may say, I don't know, internet security costs, and then some dollar amount, because you don't feel like it fits well in any other category. Having other expenses, as long as they're legitimate business expenses, doesn't increase your audit risk, doesn't create any problems. You just describe them and put them down. Now, back to the other question, because that was the easier one, which category? The other question is like, well, is it a deductible business expense? And here's how I normally explain this to people. In order to be a deductible business expense, and this is from section 162 of the Internal Revenue Code, it has to be a reasonable and necessary business expense. And so normally in accounting, we talk about reasonable and necessary business expenses for the creation of revenue, but the tax code doesn't go as far as GAAP, and so it's just reasonable and necessary business expenses. And so let me give you an example of where this becomes a problem. You have say you have this little small business, and maybe you have a married couple, and they're both working, and they have $100,000 between them in wages, and then they have this small business on the side where they're doing, I don't know, some consulting work of some kind. And they may want their business to actually lose money to shield some of their other income from taxes, which kind of gets at the hobby rules. And so what they'll do is they'll start to become egregious or aggressive with their expenses. So in an example of an acceptable versus an unacceptable expense, let's say I've got a small business and I've got $20,000 in revenue. It might be acceptable for me to go to the coast for the weekend and have a planning session where we rent a room and buy a couple of meals, and it costs $400. Because, businesses need to plan, and if that's what needs to happen in order for that planning to take place, that might be, that seems like, well, okay, maybe we can justify that. If I've got $20,000 worth of revenue low and I have a 7-day planning session in Cabo, that's not acceptable. So it has to be necessary, and then it has to ordinary, necessary, and then it has to be it has to be kind of reasonable. You know, you can't get too carried away with these things. And small business owners are sort of notorious for trying to make their personal expenses, you know, a deduction in their business. And that's, you know, that's not right. That can't be done. Line 8, advertising. Not just advertising, put all of your marketing costs in here. So public relations, you know, ads you take out in the paper, but if you do a marketing plan, you buy business cards, you know, you have envelopes and stationery done, those all can get dropped into line 8 if you're trying to market your business some. We'll talk about car and truck expenses in a minute. That's a little bit of a tricky area. Commission and fees, contract labor. If you have a large amount of contract labor on line 11, that probably means you should be, that probably means you should be doing a 1099 or many 1099s for people. So just be aware of that. If you start to grow line 11, then, you know, 1099s might be necessary. Line 12, depletion. That's the same as depreciation, only we use the word depletion when we're using up natural resources. And so in our neck of the woods, there's two ways that this typically gets done. One is aggregate mining, so mining gravel or mining rock. So you might have depletion for something like that. And then the other common one is you might have depletion for timber harvest. So if you're cutting the trees off your property, you're depleting your resources a little bit. And so it acts a lot like depreciation, but it's a separate term because they're natural resources. Line 13 is where your depreciation goes. It's calculated completely differently from GAAP, and we will spend the next week, I think, talking specifically about how depreciation works, and it's complicated enough that it's a whole chapter in the book. So more to come on that. Employee benefits programs. So if you're, I don't know, providing your employees with disability insurance or with I don't know, just whatever benefit packages you might have. And then 15 is insurance, interest that you might pay. You know, could be you have a business credit card and so you buy office supplies with it, and every once in a while you get charged interest, so you have the interest income on line 16. Credit card interest would go on B. If you had a small business and they bought a building, then they'd have a mortgage and it would go on 16A. Legal and professional services. So this is probably, you know, your attorney, getting some contracts written, maybe your bookkeeper if you have one of those, possibly your IT support person if you kind of are working with him. So not everything has to go in contract labor if it fits better in 17. So some outside services are going to fit better in 17 rather than line 11. The IRS isn't really going to care too much if you drop something in the wrong line because it's not going to change your net income. You know, if I put it in line 10 versus line 14, the net income is still going to be the same and the tax is still going to be the same. It'd be nice if we categorize things kind of consistently and as well as possible, but dropping something on the wrong line is not the worst thing in the world. Office expense on line 18. I'm going here with rent, you know, the phone system, you know, basically all kinds of things associated with having your office open. And then pensions, if you provide those for your employees. Many of these lines don't apply if you don't have employees, for example. You're probably not going to have pension and profit sharing. You're probably not going to have employee benefits. You know, so some of these things, not all lines are going to apply to all businesses. If you rent stuff, you know, equipment, machinery, maybe you lease a delivery van or car or something like that, or other property, maybe you rent a photocopier. So those go in 20A and B. And then your general repairs and maintenance, supplies that are not part of cost of goods sold. So if I buy some supplies that don't end up kind of going into the products, maybe I'm making those trailers we were talking about before, you know, we're buying steel and axles and we're welding trailers together. Those would go in cost of goods sold, but maybe I buy some paper for the office or some other thing that's I need to run the business. I buy a piece of software or something that might drop into line 22. So that's, you know, if it's non-production oriented supplies, they go into line 22. all the taxes and licenses that we pay. So we talked earlier about getting that designated business name or assumed business name from the state. If I fill out that form and it costs me $100, then I drop that into line 23. So all kinds of other business licenses, tax, those kinds of things end up in line 23. 24, your travel is completely deductible. So the cost of a flight, a taxi cab ride, those types of things, that's deductible. Your meals and entertainment, though, are only deductible at a 50%. So normally what you do is you put it, you add up all of your receipt meals and, you put in the amount and you get to deduct half of the amount. The thought being that you ate half the meal, the client or your business associate ate the other half, and so you're only getting to deduct half of it. The utilities and then wages that you pay to employees, and then we already talked about 27A, which is all of the other things that can go on in the expense category. I want to go back here and add some detail now to travel expenses and meals and entertainment. Travel expenses, in order to deduct the travel, you have to spend more than 50% of your time on business. And then if you do, you can deduct the flight, and then you can deduct the specific business related expenses. So let's say that I fly to Hawaii and I am there for 7 days. If I work 4 days, the flight is deductible. The hotel for 4 nights is deductible, and then the other 3 nights is a business expense, or is a personal expense. But I get the full cost of the flight as a business deduction as long as my work time is more than half. And so that's just kind of like some added detail there, that if people are trying to deduct these, these expensive airplane flights, sometimes we have to look at them and say, okay, where did you go and what was the business purpose? And, was it all for business? And, most of the time it is. Lots of times people tack on 1 day for pleasure or maybe to do some sightseeing while they're there, but usually most of the time it is for work. On the deductible meals and entertainment, the challenge here is that in order to deduct that, you need a receipt. You need to state where you ate, the date, and who you ate with, and what the business purpose was. So you need to make some notations on the receipt. Now, most receipts come with the location, the date, and the amount on it. And so what you really need to add to the back of the receipt is who the client was, or the prospective client, or the business associate, and what the purpose of the meeting was. And technically, without that documentation, you're not supposed to be able to take the deduction. And so what happens sometimes is people will put a large amount there for deductible meals and entertainment, and then if they get audited, they don't have all the receipts and whatnot. This is something that gets thrown out fairly regularly because the documentation must be spectacular in this particular area. So I glossed over, I didn't talk about car and truck expenses, so let's go and pick that up now, and then we'll come back to this front page. So vehicle expenses, and this is part 4 right here. I think probably at first it's probably best to understand what's going on here. You are allowed to deduct your business expenses one of 2 ways. One is to deduct your actual expenses. So you add up your insurance and your gas and the oil change and all of these expenses that you incurred. And then in addition to that, you add the depreciation for your vehicle. And so you try to summarize all of the expenses. That's one way that it's done. Or you can just say, I drove 123 miles for the year for business. And so you can take 123 miles times whatever the mileage rate is, which last time I checked, it seems like, I think the last problem we did, it was 53.5% or 53.5 cents. And so what you have to do here is you have to tell the IRS the vehicle that you're going to take the deduction for on 43. And then you have to tell, the business miles, which is the amount that's going to be multiplied by 53.5 cents. And then they want to know how many miles you drove it personally. And then they're going to ask you some questions. And so, did you have another vehicle you could use? They're trying to figure out like whether or not you're exaggerating your miles. So they ask you these evidence-based questions. 47A is the critical one, because if you check no, you can't deduct your mileage or your business expenses. You must check yes, and you must have a written mileage log. Now, that's technically not true. Your mileage log doesn't have to be written anymore because you can get an app to go on your cell phone, but you must have, like printable written. It used to be that people would carry a little book and they would write down the beginning mileage and the ending mileage and where they went for the business trip. And then at the end of the year, they would sort of add all of these things up. But absent the evidence, you can't deduct the mileage. So this is another expense that gets thrown out a lot. The person will claim some mileage on their tax return and they'll get audited, and the auditor will say, well, I would like to look at your written evidence for your mileage. And they're like, oh, I don't have that. Okay, deduction denied. End of conversation. So for the great majority of taxpayers, the mileage rate ends up being better. So the 53.5 cents per mile, and that amount, by the way, is indexed for inflation, and it changes every single year, but it's been in the low 50 cent range for the last 5 or 6 years. But I lost my train of thought there. It's better to take the mileage rate for the great majority of taxpayers. The one small exception can be people who drive a vehicle that gets really crappy gas mileage. So if you've got a ranch and you've got a Ford F-350 truck that's a very expensive vehicle, very low gas mileage, the depreciation is going to be very high, the total gas purchase is going to be very high, and in some cases, the actual expenses can overcome there. The reason why in 44A and B, they ask you the business versus the commuting, let's say I drove it 50% for business and 50% for personal use, then the actual expenses that I get to deduct are the 50%, not the total actual expenses. It's just, 50%. Most people don't deduct the actual expenses. The other reason being they don't want to keep all the paperwork in the records. And so it's easier for them just to do the mileage rate. And so after we answer these sort of evidence-based questions, we can do the calculation, and whatever that mileage times the rate is, or the actual expenses, can drop into line 9. And so that's a little bit about expenses, and some of the more complicated expense issues are the ones that get people into trouble. And then we sort of defined the ordinary and necessary and reasonableness for business expenses going into that discussion as well. So from there, remember up here on line 7, we had the income. Now we're going to have total expenses on line 28. We're going to subtract the 2 and have a profit, or maybe a loss. If I have a profit, then I may be able to deduct a home office. And I'm going to not talk about home offices at this time because I'm going to do a separate video on home offices. But in essence, if you qualify for a home office, you may be able to deduct a percentage of your rent or your mortgage payment usually based on the square footage. But there's a lot of complicated details there, so I want to address that separately. But if you're profitable and you meet all the rules of a home office, you may be able to take a home office deduction. If you are not profitable, say you lost $1,000 or you just broke even, then you can't do a home office deduction. So only to the extent that you have profit, to wipe out with a home office deduction, can you actually do one. And so that's what's happening on line 30, and it goes with this form 8829. So I'll probably do a short video talking you through the 8829 sometime later in the week. And then on line 30, we get our net profit, and then line 31 is going to be the amount that is subject to the self-employment tax. And so then you may have to go over to the self-employment form and calculate the self-employment tax. And so that's pretty straightforward. I won't go into that issue. You'll see that very clearly in the chapter. Line 32 and 32A and B, almost always we check 32A, which is all the investment is at risk. Basically what they're asking is, this money that you put into the business, could you lose it all? And if the answer is yes, then all the money is at risk. If you don't have any money in the business, then you have nothing at risk and you can't lose it. Or if some of the money is like pledged or earmarked or you can't get to it, then maybe only some of the money is at risk. The reason why this is important is you cannot take losses if you are not at risk. So if I lose $1,500 in a business, but I never invested anything in it and I don't have anything at risk, I basically don't have any skin in the game, then I can't take that $1,500 loss over to the front of my 1040 and use it against my other income, for example, wage income or interest income or capital gains income. So usually all of your investment is at risk, you materially participated, and so that makes your losses deductible. By the way, if you don't materially participate, which was something we talked about in the masthead, then you have a situation where you may have a passive loss, which there's a whole set of rules around passive losses. They may not be deductible in the present, but someday they may be deductible in the future or when you have passive income. We'll talk more about passive income and losses when we talk about with the Schedule C. I'm getting a note here that my internet connection is unstable, so I hope I don't lose you guys. Watch for another video coming on the home office deduction. And then I'm going to close tonight by saying a few things about, or at least give you the concept of a hobby business. So a hobby business from a tax perspective is kind of a scary deal, because when you have a hobby business, or when you're classified as a hobby business, your income goes on line 21 of the 1040, and you get to deduct none of your expenses. You actually maybe can deduct your expenses on your Schedule A on the 2106 on the miscellaneous itemized deductions, but remember next year the miscellaneous itemized deductions are going away. So a hobby business, you're going to report your income, but you're denied all of your expenses. And so the definition of a hobby business, let me give you an example of a hobby business. Let's say I'm a crack surgeon, just top of my game, coveted by all of the hospitals, making $500,000 a year. And I've got lots of income on my 1040, and I decide, I'm going to become a photographer, and I'm going to spend $10,000 on a digital camera, and I'm going to specialize in African wildlife safari animals. And so I'm going to fly to Africa twice a year, and I'm going to take pictures, and I'm basically going to create $30,000 worth of losses because of my camera costs and my flights and safari costs and all of that stuff. And then at the end of the year, I'm going to sell one photo, wait for it, to my mom. And I'm going to call it a business. And then I'm going to take this big loss, and because that big loss is going to be, I'm trying to make that big loss deductible, I'm going to put it over on the front of my 1040 and wipe out some of my other income. That's a hobby business. And so that's a problem for us. Now, the challenge for us is that the definition of a hobby business is not as clear as what I just made it with the example. It is a type of business where it seems like the person may not be engaged in the business for profit. They probably have bad books and records. They maybe don't have a business plan. They're getting some enjoyment out of the activity, and they have the potential to shield other income that would be taxable for your, from business losses. So let's go back to that regular photographer. If they are losing a little bit of money, but they have no other income, and they're like working 40 hours a week, and they're like taking every job that comes their way, and they're really, like the poor, broke, starving artist photographer, and that's not a hobby business because they're putting in the effort. They're not shielding other income, and they're treating and acting and behaving like a business. So a particular business in one person's hands, in one type of behavior, could be a legitimate business, and for another person it could be a hobby. Where these things come up, I put up an article today about drag racing. So there was a person who was engaged in drag racing, and in this case the facts and circumstances indicated that it was a hobby, it wasn't for real. So there's an area. Race car driving. Horses is a common one. Lots of people want to be horse breeders and try to make money in horse breeding and racing, and there's this question. It's like, well, are they really working at it, or do they really just love horses and it's a hobby for them? Fishing guides, rafting guides, but it really can be. I mean, probably nobody's going to accuse you of being a hobby business if you're a bookkeeper, because there's like seriously, who's doing that for fun? How much personal enjoyment are you getting out of that? But there are these jobs that have, that have this enjoyment nature to them, and we have to be careful with those and kind of look into them and make sure that those types of clients are, they've got a solid business plan. They're not losing money. They're trying to change their business and make it profitable. They have things at risk, and they're not taking big deductions against other sources of income. In particular, if they're not spending a lot of time in their business, because they're working in another activity. So there's a couple little articles about hobby businesses that are in the reading section of Canvas that would be great for you guys to look at. Can somebody yell and let me know if you're still there?
I'm still here.
Okay, so I think we haven't lost our internet connections then. So that's what I wanted to talk about tonight. I will move that midterm to next week here pretty darn quick so that it'll, won't cause you any concern. Here's those two articles that I was mentioning here. Here's that business entity summary. We'll get this Zoom session outfitted to YouTube and put a link in there, and then watch for a link on the home office video coming in the next few days, hopefully. Any questions at this point? Oh, let me just say on the Andersons, I hope to get those graded in the next few days. Like I mentioned at the start, it's going to be a tough week for me. I'm going to be running a little bit behind. But as soon as I get those graded too, I'll also, in the resources for this week, I'll put up the Anderson solution so that you can go, if it didn't go perfectly for you, you can go back and see where things might have gone sideways. With that, any questions or any way that I can help you guys this evening? Well, that's kind of quiet. I guess with that, thanks for dropping by, and great to share a few ideas with you, and watch for more updates to Canvas here before too long. Have a great evening.
Thank you.